Markets have definitely woken up. Following that U.S.-China trade truce announced, just a couple of days ago on May 12th,
Yeah, that's right.
we're seeing some pretty significant movement. I mean, the Dow jumped 3.2%. And maybe the most telling sign, shipping volumes, after that really steep, 60% drop, they're starting to bounce back.
Welcome to Logistics Pulse, sponsored by Mothership. Skip the broker to save big on LTL shipments, or deliver same day nationwide. For more insights like these, don't forget to subscribe to Logistics Pulse on YouTube, Spotify, or wherever you get your podcasts.
It feels like a temporary reprieve, right, in this whole complex trade situation.
Exactly. And for businesses caught up in international commerce, this limited time is it's a critical chance to reevaluate, especially their supply chain strategies.
And that's exactly what we're digging into today.
Okay.
This deep dive is all about how businesses, maybe like yours listening, should strategically respond, to this temporary relief, with a real focus on optimizing that supply chain. We figure you're probably looking to quickly grasp what this means for your operations, wanting clear info without, getting totally overloaded.
And hoping for some concrete ideas you can actually use. That's the goal.
Precisely. This 90-day window, it really demands informed action.
Right. And our analysis looking at the situation, it points to basically 3 distinct strategic options for businesses.
Okay.
So we'll break down the pros and cons of each one. And importantly, we'll look at how the seasonality of your business plays into this.
Seasonality. So whether your demand goes up and down or stays pretty steady.
Exactly. That should be a really key factor in deciding which way to go.
Okay, let's jump into the first option then. Accelerating trade and building up inventory. The thinking here seems pretty straightforward, doesn't it?
It does on the surface.
With tariffs taking such a big hit. I mean, the U.S. dropping from, 145%?
Yeah, plus of 145%, yeah.
Down to 30%.
And China down from 125% to just 10%.
Right. So there's a clear incentive there to increase trade volume now, get goods moving, build up stock before those lower rates potentially vanish in August.
That's the core idea.
And the potential upsides, they're considerable. The immediate cost savings from these lower tariffs can be, pretty substantial.
Like how substantial?
Well, for instance, Reuters was reporting that just a $10 million import shipment, it could save a U.S. business something like $11.5 million under these new rates.
Wow. Okay, that's huge. That's not just a small saving.
No, it's a significant boost to the bottom line potentially. The key insight here really is that these immediate tariff cuts offer a big, though temporary, chance for major cost savings. And maybe even gaining some market share, especially if you've got demand peaking soon.
Yeah, savings like that could really free up cash for other things. And it's not just the immediate cost, is it? It's also about meeting current demand, maybe grabbing that market share you mentioned.
Exactly, particularly if you're in a sector gearing up for, say, a Q3 seasonal peak, or even looking ahead to the holiday rush. Plus, there's a confidence factor. We saw Maersk's stock jump 12% right after the deal was announced. CNN reported that. It suggests a positive impact on supply chain stability, or at least the perception of it.
Okay, but there have to be downsides, right? It
Yeah.
can't all be smooth sailing.
Definitely not. These potential gains, you have to weigh them carefully against the risks, and the main one here is overstocking. If tariffs suddenly shoot back up to those old levels, you could be sitting on a ton of inventory that's suddenly much, much more expensive.
And that could wipe out those savings pretty fast.
It could potentially shrink your profit margins by maybe 15, even 20%. McKinsey saw that kind of thing happen back in the 2018-2019 trade war.
Ouch. Okay. And it's not just the cost of the goods, I imagine.
No, building up inventory takes capital. And we know from the Small Business Administration data that something like 60% of SMEs have faced cash flow problems before.
So tying up cash and inventory, especially with this August question mark hanging over everything, that could be tough.
It could be a real challenge. And then there's just the simple danger of misjudging demand, ending up with a warehouse full of stuff you can't sell. It's never good.
So this is where that seasonality piece becomes really critical.
Absolutely crucial. For businesses with those predictable Q3 spikes, think back to school supplies, for example.
Right.
IBIS World data suggests 15–20% of their whole year's sales happen in July and August. For them, this accelerated trade option looks pretty attractive.
Makes sense. Use the lower tariffs to bring in what you know you'll need soon.
Exactly. But even then, you need precision. Overstocking niche seasonal stuff like, specific summer clothing styles, that's riskier if tastes shift.
Okay, so what about businesses without those big seasonal swings, say semiconductor makers?
Right. For non-seasonal businesses, the ones with more consistent demand, this option is still appealing, mainly because of those steady cost savings.
And less risk of overstocking.
Generally, yes. The risk is lower because their sales patterns are more stable. They can build up a bit of a buffer inventory without that same intense pressure of a seasonal deadline looming.
Okay, so let's say a business decides, yep, this is the route for us. How should they actually go about implementing it?
Well, it differs a bit. For those seasonal businesses aiming for Q3, it needs to be really data-driven,
Meaning,
meticulous demand forecasting, using their point-of-sale data, watching consumer trends closely, maybe using tools like Google Trends, and probably being a bit conservative on the inventory buildup.
like not going all in.
Maybe capping around, say, 60% of what they project they'll sell, just to mitigate that overstocking risk we talked about.
Okay, and for the non-seasonal guys?
They could probably build inventory closer to maybe 80% of their normal levels. It strikes a balance between grabbing those tariff savings and keeping some flexibility.
Got it. Anything else everyone doing this should consider?
Yes. Securing trade finance is key. We saw mentions of things like JP Morgan trade credit being available and negotiating short-term deals with suppliers to really make the most of this window. Those are essential steps.
So bottom line on option one, who's it best for?
For seasonal businesses with that Q3 peak coming right up retailers especially, this is probably the priority. But, that's a big but, with very careful forecasting.
To avoid getting stuck with stock.
Precisely. For non-seasonal businesses, it's worth a hard look if the tariff savings are significant for their cost structure, maybe over 10%. But still, proceed with caution, given the temporary nature of this whole thing.
Okay, that's clear. Let's shift gears then. Option two, diversifying supply chains away from China.
Right. This is a different approach entirely.
The idea here is to actively start moving sourcing to other places, Vietnam, Mexico, India, places like that, with the goal of being less reliant on that US-China route by August.
Exactly. This is much more about the long game, building resilience against potential future disruptions.
So the benefit isn't just immediate cost savings, it's risk reduction.
That's a major part of it, yes. If tariffs do snap back or even go higher, businesses that have already started diversifying will be less exposed. And we're already seeing this trend, actually.
Yeah.
The U.S. Census Bureau reported a pretty significant 22% year-over-year jump in Vietnam's exports to the U.S. So companies are already moving in that direction. The key insight here is that diversification builds that long-term strength, but it costs money and takes time up front, which makes it tricky for immediate seasonal needs.
And presumably there could be cost advantages in these other locations too.
There could be. Sources like BCG mentioned Mexico potentially offering, say, a 30% cut in shipping costs compared to China, or India having maybe 20–30% lower labor costs.
And this also seems to fit with some broader U.S. policy trends, doesn't it? Like nearshoring and the CHPS Act.
It certainly aligns with those initiatives, yes.
Yeah.
But again, diversifying isn't quick or cheap.
Right. What kind of costs are we talking?
McKinsey estimates relocation costs can be anywhere from, well, $5 million up to $50 million. Depends hugely on the scale and complexity.
Okay, not pocket change.
Not at all. And then there's the time factor, finding, vetting, and onboarding new suppliers. Deloitte suggests it typically takes 6 to 12 months.
6 to 12 months, that blows the August deadline out of the water.
Pretty much for any major shift. And you can't ignore potential quality issues either. Some older AmCham data indicated, 40% of U.S. firms had run into quality problems when they first started sourcing in Southeast Asia.
Okay, so quality control is another hurdle. Now, how does seasonality impact this diversification option?
Well, for those seasonal businesses, especially with Q3 breathing down their necks, trying a major supply chain shift in just 90 days, it's generally not advisable.
Too risky.
Very risky. Deloitte used the example of a toy retailer. If they tried switching suppliers right before the holiday season, they could face major Q4 stockouts, maybe lose 10–15% of their revenue. That's a huge gamble.
Yeah, that sounds like a bad idea right before your peak season. What about the non-seasonal businesses again?
For them, it's more feasible. Their stable demand gives them more breathing room for a gradual transition.
So they don't have that immediate seasonal pressure.
Right. A medical device company, for example, might be able to pilot sourcing some components from Mexico within this time frame. Maybe start realizing some of those 20% logistics savings BCG mentioned.
Okay, so for implementation, how should businesses approach diversification, keeping those seasonal differences in mind?
For the seasonal guys, it's probably best to plan any serious diversification for after August. Maybe start small now, like a pilot program for just one product category, maybe 10% of their sourcing, just to test the waters.
Dip a toe in.
Exactly. Non-seasonal businesses can be a bit more proactive. Start actively scouting suppliers now in places like Vietnam or Mexico. Maybe set a target of, say, 20% diversification by early next year, Q1 2026, perhaps.
And for both, any tools or partners they should look at.
Absolutely. Using third-party logistics providers, 3PLs, like DHL, for instance, can be really helpful. They often have expertise in vetting suppliers and ensuring quality control in different regions.
So the final recommendation on option 2.
For seasonal businesses, the advice is generally avoid major shifts right now. Focus on option 1 or maybe option 3.
Got it.
For non-seasonal businesses, though, especially if they have the capital and are thinking long-term, this could be a priority. Their stable demand can better absorb the bumps in the road that come with switching suppliers.
All right, that makes sense. Let's move to our third and final strategic option. The wait-and-see approach, but with cost optimization.
The conservative play, essentially.
This sounds like, basically, keep doing what you're doing, but really tighten the belt on costs and watch those trade talks like a hawk until August.
That's the core idea. And the main advantage.
Yeah.
Preserving liquidity. Cash is king, right?
Especially now.
Exactly. With reports from the Fed suggesting SME lending has tightened by maybe 10%, just holding on to cash and avoiding big upfront investments could be the smart move for many.
So it keeps your options open.
Maximum flexibility. You're not locked into a big inventory build or a complex supply chain shift. You can react quickly based on what actually happens with the U.S.-China talks in August.
And you avoid the immediate risks of, say, guessing demand wrong or running into problems with new suppliers.
Right. The key insight here is that waiting prioritizes cash and flexibility. But it does risk missing out on current opportunities and might delay necessary long-term changes.
Okay, so what are those potential downsides? What's the risk of just waiting?
Well, the big one is missed opportunities. If competitors take advantage of lower tariffs, option 1, or start diversifying, option 2, you could lose ground.
How much ground?
Bain looked at a similar tariff pause back in 2019 and suggested businesses that waited could have lost maybe 5 to 10% market share.
Oof, okay.
Plus, even with this truce, those U.S. tariffs are still at 30%, right? So that pressure on your profit margins doesn't go away completely.
True.
And finally, just being purely reactive. If tariffs do get reimposed or even increased after August, you might be scrambling to adjust when you could have started sooner.
Right, you lose that lead time. Now, how does seasonality play into this wait-and-see approach?
Again, it's critical. For seasonal businesses gearing up for Q3, think electronics, where IB's World says Q3 can be like 20% of annual revenue.
Yeah.
Waiting is pretty risky. Doing nothing could mean serious stockouts of demand surges, and they didn't adjust inventory.
That sounds like a potentially very expensive gamble if you're heading into your peak season. What about the non-seasonal folks?
For them, waiting might be more appealing. Their steady demand makes it easier to absorb ongoing costs. Maybe they use strategies like hedging.
Hedging, like protecting against price swings.
Exactly, like taking out insurance against cost increases. For example, companies in chemicals might use futures contracts to lock in prices, something S&P Global has noted.
Okay. So if a business does choose this wait-and-see option, what practical steps should they be taking? It's not just doing nothing, right?
No, definitely not. It's active waiting focused on cost optimization. For seasonal businesses facing that Q3 crunch, maybe they could hedge, say, 50% of their estimated tariff costs to ease some margin pressure. And maybe consider passing on a small portion, perhaps 30% of the remaining cost, to consumers via slight price adjustments. It's a balancing act.
And non-seasonal businesses.
They might hedge a larger chunk of their costs, maybe 70%, and really focus on implementing lean operations, trying to find those 5–10% cost savings Bain mentioned.
And for both, staying informed is obviously key here.
Absolutely paramount. Constantly monitoring official channels like the USTR, keeping tabs on insights from trade experts, maybe following key people like Scott Bessent on platforms like X. Staying plugged in is non-negotiable with this strategy.
So the final word on option 3.
For seasonal businesses with that near-term Q3 peak, probably the least ideal option. The stockout risk is just too high. Maybe more feasible if your peak is later, like Q4.
But for non-seasonal businesses,
it could be a strong option, especially if preserving cash and flexibility are the top priorities right now, given all the uncertainty.
Okay, we've covered a lot of ground with these 3 options. Let's maybe zoom out for a second. Are there things businesses should be thinking about no matter which path they're leaning towards. Some cross-cutting considerations.
Absolutely.
Yeah.
And the first one, which we've hit on a lot, is really understanding your seasonality. It's the linchpin.
It dictates so much.
It really does. Q3 peak businesses. Probably lean towards option 1. Q4 peak businesses. Maybe option 3 feels safer for now, non-seasonal. Option 2 for the long haul. Or option 3 for flexibility.
And staying informed, that seems like a constant.
Crucial. Policy monitoring isn't optional right now. Keeping track of the key players, Scott Besson, Jameson Greer on the U.S. side, people lifing in China through reliable news like Reuters or even platforms like X, it gives you vital context.
And it sounds like you shouldn't just pick one strategy and, hope for the best.
No, definitely not.
Yeah.
Scenario modeling is essential. Businesses need to be actively thinking through different possibilities.
Like what happens if tariffs stay low? Or go back up partly or fully?
Exactly. Model out 0% tariffs, maybe 10, 20%, all the way up to that 145% possibility. And crucially, layer your own seasonality onto those scenarios. How does each outcome affect your business at your key times?
Are there specific tools for that?
Well, techniques like Monte Carlo simulations, which HBR has written about, can help model those different potential outcomes under uncertainty.
Okay. And finally, this isn't just an internal exercise, is it?
No, stakeholder engagement is vital. Talk to your investors, your customers, your suppliers.
Tell them what you're thinking, what your plans are.
Yes, be proactive about communicating your strategy and how you're planning to be adaptable. McKinsey found that back in the 2018 trade war, something like 80% of S&P 500 companies did this. It builds confidence. It's just good practice.
Okay. So, just to bring it all together, we've looked at 3 distinct strategic responses to this temporary U.S.-China trade truce.
Right. Accelerate trade and build inventory now.
Option 1. Or start diversifying your supply chain away from China.
Option 2, the long-term play.
Or adopt that wait-and-see approach, focusing on optimizing costs while you monitor the situation.
Option 3, the flexibility route.
And as we've really hammered home, the best choice for you, listening right now, it really hangs on your business's specific seasonality and, frankly, your company's tolerance for risk.
Exactly. There's no single right answer here.
And it's so important to remember, this 90-day window is temporary. As good as the market reaction feels right now, proactive planning is absolutely crucial. You need to be thinking about how to handle potential disruptions, whatever happens in August.
Which really leads to a bigger question for you to chew on, doesn't it?
Yeah.
Beyond just these immediate tariff moves. How is this whole period of volatility, this temporary truce included, fundamentally reshaping global supply chains?
Good question.
And maybe more importantly, how can your business strategically position itself, not just for the next 90 days, but for long-term success in whatever this new landscape looks like, regardless of the August outcome?
So, thinking beyond the immediate reaction.
Yep. What foundational changes might you need to make now? Not just to survive potential future storms, but to actually thrive in what seems likely to be a more unpredictable global trade environment going forward.
For more insights like these, don't forget to subscribe to Logistics Pulse on YouTube, Spotify, or wherever you get your podcasts.